Guys, I still have 2 spots left for coaching. Anybody who wants coaching in the next year, hit me up on Instagram and happy to chat with you guys and we'll go from there. Hey everyone, welcome back to the Mark Loeffler Experience. Well, we're going into the new year and let's do some predictions. We're going to talk real estate in today's video and where the RBC thinks it's going, where the people think the economy is going, and yeah, what my personal opinion is of what we're going to see in 2023, and are we in a recession already? Because that's what a lot of people are talking about. But if apparently from the pictures of the Boxing Day shopping at the Eaton Center, we are definitely not. But I went to Canadian Tire just for whatever reason, and there was really nobody there. But I guess that's not the hot spot. Here's the headlines, right? Canada's real estate bubble is now the largest ever correction needed, RBC. And they're saying it's going to be bigger than the 1980s bubble, which I think we already are. We're already down 35% from the peak. They never saw that back then. Bank believes it will take years to undo the price damage done by the 2021 price surge. We know those 3 months where we went up stupid money. Yeah. Well, I mean, here's the thing, right? At the end of the day, it's more expensive to buy a home today and get interest rates today than it ever has been. It takes more of your income right now to buy a home than ever before. So we know we're already going to see the biggest drop in history, right? We know that. What's going to happen moving forward is the real key. So this is 2017, 2008, 2009, 91, and then you have the 1980, 81. So I've compared this to it feels like the early 90s again, right? They didn't obviously have the same drop like that's a huge drop. Like it happened in the 80s. That's the 80s right there that had that huge drop. So we're going to see a bigger drop. And if you lived through the 90s real estate, you knew it was pretty flat. It took another 10 years to get back to the peak. I think we're going to be in for very, very similar. I think we're going to have interest rates that are more expensive than they have been for a long time, for a while now. I think we are flattening out. The curve is flattening, whether it's in COVID or in real estate. So what helps with real estate? What helps with affordability? Well, obviously we're having inflation. So when we have inflation, we have wage inflation. When wages go up, people obviously have more, you're earning more money, well then less of that portion goes towards your house, right? So therefore it becomes more affordable based on your income. If interest rates go down, right, then the cost to borrow goes down, and your cost, this is all based on your monthly cost, not how much it costs to buy the property, right? Obviously, this year has been just a cluster for a lot of things, but real estate in general, we had the spike, we've had the drop. It's just been. And there's going to be more and more people hurt from this. Like we're dealing with some stuff right now that's going through the process that they may not be able to sell because they owe more on it than it's worth. And I mean, who's taking the haircut? Is really the question right now is who's going to take the haircut. And that's probably going to come on more. Like some of these evaluations people bought at, and if they don't have the capital to be able to sustain it and take the project to fruition, then you're going to see some people dumping stuff on the market at some point. So you can see that Oxford Economics is calling for the trough to begin in 2023. I don't think we're going to see that much down, but I mean, who knows? And then flattening that curve again. And we're just going to see that nice and steady market, which in my opinion is way better for everybody. You're not seeing 25, 30 offers on a property. But yeah, I mean, obviously price drops, like it takes capital out of the market. Therefore, people will spend less. They'll buy less cars. They'll buy less boats, cottages, whatever they're going to do, decrease people's wealth overall. Now, obviously, one of the biggest things that's sustaining us right now is we have a very strong employment market. We have seen cuts in tech, but not really anywhere else just yet. And that is really sustaining because that's driving wage growth. So if that softens, then obviously we're going to go into a full-blown recession. I mean, the Bank of Canada sees unemployment rate going up to 8.1%. That's roughly 1 in 13 adults ready and unable to find a job. And then obviously there's a whole bunch of people coming into this country with immigration, and that's, I don't know, that it's going to make it worse. But at the end of the day, I don't feel that we're going to get that high. They're calling for us to, Bank of Canada, to keep it around 4.25. I think that's a bit of a pipe dream. I think they're going to continue with a couple quarter point increases next year into the mid and then stop. So Canada GDP growth. So Oxford Economics thinks that we're not in a recession, because a recession is 2 quarters of negative growth. That's going to be a negative quarter into the third quarter. So basically, they're basically saying we're going to see 4 quarters of negative growth before we see growth at the end of this year, which would include consumption, residential investment, business investment. Not really any. So one thing I find funny in this is they're not calling for government intervention, which I hope that this is the case. But usually when we get into recession, they announce these massive spending bills, and again, I don't think that's needed here. This is more of a inflationary recession, and if we pump more money into the economy, then that's going to increase inflation. So it's going to be really interesting to see what they do, because they can really, really screw this up. They can screw this up for a long time to come. I'm hoping that this is what we see. Obviously, like you can see, consumption went negative, is not negative, but is shrinking. Residential investment's been shrinking because people are scared. People don't know what to make of this market, right? Inventory, so that means we have much more inventory sitting on the shelves. It's all like net exports. That's the one good thing. Like, we are an exporting country with food, oil, and then government is adding some, but we're going to see decreases in government spending, which I'm for right now, to be honest with you. Okay, so 2023. Let's talk 2023. I think we're at or near the bottom of the market, unless they do drastic rate increases. I don't think we're going to see those anymore. So the real estate market, which is funny, like, you talk about, and they've always talked about this, Vancouver costing 96% of the average salary to buy a house there. Toronto is like 75 or 80%. So this is the pre-tax income needed to qualify for a mortgage. Victoria's 216, Vancouver. Anyway, we digress. You guys can look at that. We'll put it on the screen for you. Toronto is 85%. So if you're living in Toronto, buying now in Toronto, it's 85% of your income to purchase that home, which is unreal. So let's talk 2023. I'm hoping that is the predictor of that recession is very, very accurate. I think we're pretty much level. We might see a little bit more decline in the real estate market, but I think we're pretty much level. Could that be thrown off by, again, interest rates or the job market, right? Like, if that job market hits that wall, then we are going to see more pain. And obviously affordability is going to come down as wages go up with inflation. So let's really look at this, and we look from the peak. We're down, let's call it 35%, and we've had 10% inflation. So we're really at a difference in that price of 40-45% from the peak last year. Because when they talk about that whole package, right, that's what they're looking at too, is let's include inflation in there, let's include all these things, and let's really go deep and figure that out. And that's kind of so we're off 40% from the peak. Will we get to 50% like people thought? Maybe with inflation. I don't think they're going to cool inflation until 2024, although if it's trending down, which it is, then they're going to stop with the interest rate hikes. They're going to, oh, this is where we need to be. It's going to cool spending, which again, less spending equals less jobs. So that's my real fear, is if that job market really declines, then we could see more pain. As for the stock market, your guess is as good as mine at this point. You know what? Pick up good dividend stocks and sell some calls on it. That's my recommendation. Other than that, everyone, I will see you next year. Have a great rest of your 2022, and I will see you in 2023, and let's all go make some money.